Welcome to Business Owner Bootcamp, the WellSpire Advisors podcast designed to help business owners and entrepreneurs take control of their finances. Hosts and financial advisors Michael Delgass and Sandy Wiggins break down key topics like tax strategies, exit planning, business valuations, and real-world experiences with expert guests. And now, here are your hosts, Michael Delgass and Sandy Wiggins.
Hello, everyone. My name is Mike Delgass, and I'm co-host of WellSpire's Business Owners Bootcamp podcast. This is the 8th episode in the podcast series, and I hope you'll continue to join us for future episodes where we will discuss working with business owners on post-sale personal goals and further advanced tax planning. So thank you for joining today, and hope you will continue to join us. I am an advisor at WellSpire, working with clients across the country with a special focus on families that own closely held businesses. And I'm joined today by Ramsey Goodrich. Ramsey is an investment banker and principal at the firm Carter Moore Goodrich. And I'm really excited to speak to Ramsey today because he has some great insights into the practical steps business owners need to take prior to sale. He will help us answer the central question of, when you're thinking about selling, what's really important? So thank you for joining us today, Ramsey.
Absolutely. Thanks for having me, Mike. Really appreciate it.
So before we turn to that question, can you tell us more about yourself and about the firm?
Sure. So Carter Moore Goodrich, we're a boutique investment bank in Southport, Connecticut and Providence, Rhode Island, focused exclusively on families and founders doing their once-in-a-lifetime transaction. We don't represent private equity funds. We don't do big corporate carve-outs. Only first-time, only-time sellers doing really important transactions. We love families and founders because it is really important. A private equity fund flipping a portfolio company to another private equity fund is arguably less important. When you're dealing with a second, third, fourth, fifth generation family business where legacy is everything, it really becomes very important and very emotional. So I wish I had a psychology degree or a therapist degree more than in my MBA, but it's a lot of fun for sure.
What size transactions do you typically work with?
Yeah, we love those businesses that are mature enough to have really good infrastructure, but yet perhaps need a little bit more professionalization. So our marketing collateral says 25 to 250 million. I would tell you we've done deals on either side of that.
Got it. And any industries that you focus on in particular?
Yeah, 4 key industries. If you go back a few generations, we didn't have healthcare technology. We didn't have software. We didn't have IT. So we don't really represent those kind of companies. We have good friends in the industry that do. But we really focus on 4 core areas: niche manufacturing, consumer products, including food and beverage and household products, business services, everything from fire, life safety, landscaping, janitorial services, really facility management as much as anything else. And lastly, HVAC. I hate the pun, but HVAC is really hot. Or is it really cool? I don't know, but it's there's a lot of
good news about it, I guess. Yeah. Okay. All right. Thanks. So, when is the right time to start thinking about a sale? When's the right time to call you? When should my clients start thinking about this?
Yeah, and you're going to hate my answer, but yesterday. It was always the best time.
That's
to start
harder.
planning.
Okay. Yeah. Okay.
The second best answer is today. There is no shortage. One of our key attributes of what we bring to the table is that holistic preparation. It's not about the transaction. If I can increase the purchase price by 20 or 30%, that's great. Everybody wins in maximum value. Fantastic. But if Uncle Sam takes half, or with an estate plan that doesn't work, or you haven't thought about the structure of the deal, or you didn't plan for it going in, the results are mixed. So we really focus a lot of time on that. So take your time in getting up. If you're going to do it once in your lifetime, do it right the first time. And so really take that investment. One of our core criteria that we look for in our clients is those that are willing to invest in their own success. Meaning, get the quality of earnings, do the estate plan, figure out what the tax implications are, clean up the low-hanging fruit. Most guys focus on how quickly can I get to market? How
Mm-hmm.
quickly can we close? I've made the decision, I want it done. Well, those are the deals that you read about in the paper that fail. If you really take a step back and say, okay, I've been doing this for 1, 2, 3 generations, maybe a few weeks or a couple of months are worth the investment of time in planning, and going from there. So to answer your question, the best time was yesterday. How long does it take? Everybody has a different set of preparation, but we've worked with companies anywhere from a couple of months before launching to a couple of years. It really depends on the thoughtfulness that goes into it.
Who are the right people on that team, and how do you build that team as you're getting ready?
So we actually wrote an article about this a little while ago, and we call it the core four. You need 4 real good advisors in the room at the same time. First and foremost, and this sounds totally self-serving, only because it is your wealth manager and trust and estate planning, right? For most of our owners that are doing that 100, 200, $300 million deal, that's generational wealth. And so you really have to figure out, how do I think about estate planning? How do I think about gifting? Can we put low basis stock in a slat or a grat? How much money do I want the kids to end up with? What is the philanthropy side of things? And then working with wealth managers to say, how much do I need? And estate planning to say, how much can I pass on? Is really the first starting point of everything else. Second one is really accounting and tax. You have to have a trusted advisor that's specific to M&A. And there's really 2 pieces. First and foremost is the tax analysis. What's it going to cost me? Everyone focuses on the headline number, but we concern ourselves with what actually goes in the bank account at the end of the day. So start with the tax planning there. As you get closer to a transaction, we do what has become standard is a quality of earnings. The buyer is going to come and look at all your financial results no matter what. So how about you get ahead of it? How about you look at your own financials and reconstitute the income statement and the balance sheet for what would be normal post-closing? It's amazing, and legally, not pressing any boundaries here, most tax returns or income statements are designed to minimize reportable income.
Right.
That is the worst basis for valuation if you're trying to maximize
You're going
value.
the wrong direction. Yeah.
Right. So how about we reconstitute that and relook at it as if we didn't put the country clubs and the cars and the vacations and the houses through the business, but rather what really is profitable if there was a change in ownership. So accounting and tax is the second group that you need to have in the room without question. Thirdly is a really good M&A attorney. I joke about this sometimes, that saying dentists and brain surgeons are both medical doctors. They both went to great medical schools. They've both been in practice for years. They both use a drill. I would never trust a dentist to do brain surgery, right? And that's the kind of thing you have to think about with your lawyer. If you want the best M&A attorney that has done hundreds of transactions, ideally that knows something about your industry as well, so that they can get through the red tape faster. And so don't use your divorce attorney. Your corporate guy is not the right one. The guy who helped you buy the real estate is not your right attorney. Go get the M&A attorney that really knows what he's doing. Lastly, the fourth person you need in the room is a really friendly investment banker.
You know any of those? Okay.
Totally self-serving, right? But our job is to play quarterback between those 4 different factions and the dozens of other advisors we can pull in depending on what's needed for the situation. We drive the process. We can help owners think through the options and then design the perfect outcome and then go from there. You really need to think about the definition of success beyond anything else. What is it that you want to do? Some of the questions you need to ask. What do I want to do post-closing? What about my management team? What about my employees? What about my community? Those become really, really important. And so looking at how do we design the right process, the right outcome, and the right partnership is more important than anything else. The dollars will take care of themselves if you find the right partner.
So, and this may bring in the other professionals you were talking about, but when I'm trying to get into valuation and understand what number I should be thinking of, what are the aspects I need to think about? What goes into that computation?
Yeah. So valuation is both art and science. If remember, first semester MBA, NYU Stern, Onslaught Motors, the most amazing valuation guy on the planet, happened to be my professor, and there was very technical analysis of how you do valuation.
Mm-hmm.
I will tell you that it's irrelevant. It gives you a set of
Okay.
guardrails to do it. You look at public companies. How many small privately held businesses are operated like public companies or are liquid that you can get in and out? None of them. So while it's a good guidepost, it's not the only basis for valuation. Then you look at public company M&As or private company M&As in your industry. The challenge with that is we don't disclose purchase price to anybody. So the data set is A, limited, and those that do report it, probably not 100% accurate.
Mm-hmm.
And so it's a guardrail. It's a good way to think about things, but at the end of the day, it's not reliable. The third way we do it is, technically speaking, is a discounted cash flow. Don't tell Dr. Demoterin this, but you give me what the answer you want, and I'll change the assumptions to get there. So between growth rates and discount rates and assumptions, we can make it anything you want. But that gives you a good frame of reference. Then you look at valuation is the inverse of risk. So how do we mitigate risk? And that comes into things. How do you value brand? You really can't, but I know it. How do you value the quality of management? I don't know, but if I have redundant management and successor that have been proven to be successful, great. As we like to say, you get credit for momentum. That goes in both ways. If you're on the upswing, you get credit for momentum. If you're on the downswing, you get credit for momentum. What we don't like to see is the deadline hot and then all of a sudden a hockey stick. You don't get credit for that until you prove momentum. So it's the art of things as well as the science. Science gives you the frame of reference. Manufacturing companies are 6 to 8 times EBITDA. Healthcare technologies are 12 to 15. So now all of a sudden you're sitting there, well, why isn't my manufacturing company worth what my buddy sold his company for at the country club? It's a different frame of reference. So you don't listen to your buddy at the country club.
Yeah, those multiples do not travel necessarily through different industries, different companies.
No, our focus, if you look at valuation, is pretty simple. EBITDA times multiple plus or minus adjustments. EBITDA, that's why we do the Q of V. We put the best light on EBITDA, the free cash flow, as you possibly can. The investment banker needs to focus exclusively on the multiple. How do we really drive that multiple higher? If I get a half a turn higher times whatever your EBITDA is, that's worth a lot.
Yeah.
So we look at risk mitigation, we look at growth strategies, we look at a clear vision for the future. If that clear vision is there and somebody buys into that vision, the partnership can be magic. The adjustments piece, I will tell you, having done a couple hundred of these, I've had one positive adjustment and lots of attempts at negative adjustments. So the more you prepare, the least you minimize that adjustment factor.
So, I mean, you talked about risk in the context of multiples and that kind of stuff. What are some of the things that I, as a business owner, could do to change that multiple?
Yeah, but we look at things like customer concentration or vendor concentration. If we have one client right now, 50% of its sales is with one customer. That's a risk.
Yeah,
that's a real risk. So how can we make an argument to say that we have different vendor numbers, we have different programs, we're on different platforms. Okay, that risk can come down a little bit. But if I had a diverse customer base, it's worth more. If I have a customer that has thousands of contracts and one that has one really big one, well, which one's more valuable, right? If I have not invested in my management team, who's going to take over the company next when the owner leaves? That's a real risk. So I have to discount the value of the business for the lack of management. So there's no magic bullet. Every company, like every owner, is different and unique. And so really we have to come in and sort of think about best ways to do this. So there's no magic bullet, there's no right answer, but all of them add up to a much better outcome.
I think you've told me in the past that management is one of the best investments you can make. And I think sometimes that's hard for business owners to get their head around because they're like, well, I'm the management, so I've made investment in myself. That's got to be great, right? Right? I mean, so why is that, and how do you think about that?
Yeah. So put yourself in the buyer's shoes. I've just put generational wealth into your pocket. How motivated are you, the only decision maker, the thing that everybody knows, and the only guy that can make a decision? And you created a culture that everybody comes to you. Well, you're not going to the office tomorrow, or you may
Mhm.
not. Well, that's a risk,
Yeah.
right? So now, if I've invested in management and given them the authority to actually run the business and made myself redundant or replaceable, where's the risk? It's not, because that guy's already making the decisions, already running it, already knows where the bodies are buried, already knows how to solve the problem. And so I continue to believe the best investment going into a transaction is really upgrading management. Management and systems is the other one.
Okay.
So
Talk to me more
systems,
about systems. Yeah.
yeah, you need to make data-driven decisions. Most entrepreneurs do things by gut and by feel.
Hmm.
Most folks really think about, well, this is the way we've always done it, right? Doesn't make it right. It just makes it the way
Hmm.
we've done it.
Right.
So most investors want to come in, again, if we think about risk mitigation and growth potential, we should be making data-driven decisions. I should know exactly what the profitability of each customer, of each product, of each category, fully loaded. Should I ramp up this product or that product? Should I ramp up this sales guy or that sales guy? Should I go into this new industry or not? But I can't do it based on feel. I have to do it based on data. So the better the systems, the better the outcome. We love to get to a client and he says, oh, well, you want that report? Click, there it is.
Mm-hmm.
I always hate it when somebody says, well, let me print it out from my dot matrix printer. I'll scan it and email it to you.
Right.
Hold on. How are you making a decision on this? Right.
My
So,
idiot brother-in-law is in charge of finance. I've got to go talk to him. Yeah.
all right. So you brought it up. I wasn't gonna go here. But the other best thing that you can do is fire your brother-in-law. Right.
Yeah.
We say that jokingly. Sorry, no offense to my brother-in-law. But most of the time, family nepotism does come into play. And
Hmm.
by whether it be your brother-in-law or that problem employee, you're handing that problem to the next guy, for which I need to decrease value. And the way
Right.
I decrease value is by reducing the multiple. So now you've got an option to make. Do I
Right.
pay my brother-in-law 2 years worth of salary to leave? By the way, he now becomes an add back. And
Hmm.
so now that's free to me and I can keep my multiple high. Or do I decrease the income statement by my brother-in-law's salary and decrease the multiple that applies to all of my EBITDA? And so, yeah, it's a go fire your brother-in-law. Take advantage of the low-hanging fruit. You know where it is. Just go do it.
Yeah. You know where it is. You may not be excited to do it, but now's the time. Yeah.
Yep.
Um, so, now that we've kind of cleared the decks and thought about earnings and tried to maximize multiples, what does the transaction process look like?
Yep. So all in, again, separating preparation, because that's a really thoughtful process that if
Mhm.
you're well prepared already, you can launch right into a process. If not, it could take months or years. When you say go and hire your friendly investment banker, um, we generally say it's 7 to 8 months. Having done this a couple of hundred times, um, my shortest transaction from start to finish is 28 days.
Wow.
From introduction to the client to closing, he had a highly motivated buyer with a highly motivated seller that needed to get it done by year end.
Hmm.
Had to happen. Wasn't the greatest deal ever, but it was really fast. My second
Yeah, that
fastest,
must be a December 1st call you don't
pretty much.
necessarily
Yeah, it was a
want.
Thanksgiving call.
Yeah.
Yeah. Um,
Wow.
the second one, my second fastest is 6 months, and that
Mm-hmm.
started with an offer. We didn't go to market. We generally say it takes 2 to 3 months to prepare, a month in market to solicit offers, a month or 8 weeks of management meetings and further due diligence, and 2 to 3 months to close, depending on how prepared you are. So that puts you at 7 months. 8 months is more realistic because people are doing more due diligence and diving deeper than they ever have. If it goes more than 9, we've had, I like to call it a change in strategy. The market's turned, something was found in due diligence. We had to address a different issue. We recently worked with one company, family business, multi-generational, and in the middle of the transaction, we said, hold on a second, there's this acquisition over here that we love. So we put our sale process on hold, did the acquisition, added a ton of value, and then came back to the sale process. Our valuation was much better. We proved that we were a platform. It worked all the way around. And change in strategy.
That's interesting. So that acquisition, was that something that you discovered and targeted in the course of getting ready in due diligence, or was that something that the client had kind of in the back of their minds for a while?
Ryan had always thought about doing acquisitions, but he'd never done one.
Mm-hmm.
And so there was an opportunity that frankly had presented itself that out of pure serendipity, that the other owner approached our owners and said, hey, we're thinking about selling, our timing is right. We love you guys. We do a lot of work with you. How about we just do this together? Sure. That sounds perfect. It was super easy. We done it in just a few months, and it was a home run for both sides. We're doing that right now with another client that a target actually is in bankruptcy. And so now that we know that it's going to be a sale, we might as well go after it.
Mm-hmm. So that was another kind of serendipitous,
Purely.
somebody went into bankruptcy, flag goes up, and okay.
I don't generally recommend doing an acquisition to sell. But when it's appropriate, it can be transformative. Most business owners in our world, families and founders, have never done an acquisition before. So it's big and scary. And there's a lot of risk that's involved. We would rather partner with somebody who is really good at acquisitions and tee it up get credit for that acquisition with the next buyer who knows really how to do it and how to evaluate it, how to mitigate risk, how to get it closed, how to finance it, all this other stuff.
So I guess that could help on the EBITDA side, if it's the right transaction. It might also help on the multiple and risk side too, I imagine, just because you grow the top line and you're probably reducing risk on at the margin at least.
Customer diversification, end market diversification, access to new technology, access to new management. There's usually softer issues that really drive that process more than the math.
Got it. Yeah. So I don't know if I'm a business owner, I'm probably approaching this with some trepidation, right? Because it's my baby, and I've got to sell my baby. It's hard. What are the fears you see most often, and what do people need to kind of get past to get this done successfully?
Yeah. Well, let me start with you mentioned it's selling my baby. I actually had a client in California that was a 6th-generation family business.
Wow.
So you thought it is really emotional for him.
Yeah.
And he had a son that had chosen not to come in the business, which sort of hurt him personally to pass it down to the 7th generation. And he said, I would rather sell my son. He's just a cost center.
Well, now anyway.
He's just a pain in my neck. This is my baby. That's my child. I would, and so it's hard for me to sell my baby. I have so much emotion and thoughtfulness and stress and joy and exuberance and pain and suffering in my baby, my business.
Right.
The kid, he's just a screw up. So it's really important to get that right. But coming back to some of the fears, we love one of our key metrics for evaluating our clients is for looking at transactions that go beyond just maximizing value, but where value means more than just money. So what we see is people really saying, how do I take care of my employees? How do I take care of my management team? How do I take care of my community? We worked with one company in a rural town that literally the diner was the wife of one of the guys on the factory floor. The hair
Hmm.
salon was the girlfriend of the controller. And you look at all these weird
Yeah.
intermingled things that it was really important that the factory stay where it was because the whole town and the surrounding towns was dependent upon that one factory. So
Yeah.
that became a real source of value more than anything else. So it really starts with having a really clear vision of the definition of success,
Hmm.
both personally as the owners, what do I want to do, but also what we want to do for employees, for management, for community. And thirdly, where do you want to take the business to go? At the end of the day, your name is still on the door post closing. It's still your legacy that needs to be taken care of after
Hmm.
closing. And so, really, it's creating that vision of where are we going? Why are we doing this? And frankly, that comes with being a little vulnerable of saying, where are my weaknesses? Most investment bankers will say, hey, look, let's go put some lipstick on the pig and say how wonderful you are. That's great,
Hmm.
except that leads to bad partnerships because the truth isn't on the table. What we try to do is say, hey, look, we have this great vision. This is where we're going. I need help here. And now here could be operations or it could be sales and marketing. It could
Hmm.
be management. It could be, expanding a new facility. I don't know what that is yet. And so, but to say, hey, I need help here. Now we get to go and find the right partner for the company. They value because they see that because they've done it with other portfolio companies or other divisions, they know how to get it done. They'll see more value in it. Less perception of risk increases value. I've done it before. Great, that's easy. Um, but the guy who focuses on sales and marketing is not the folks that would change the operations. So we have to be really vulnerable and honest about weaknesses and turn them into opportunities and then go find the right partner at the end of the day. Most guys
So,
say that, I read the Wall Street Journal and I hear about all these failures and how M&A fails
mhm.
and how private equity is evil. They're not. If you find the right partnership, it can be magical. Um, but you've got to focus on the partnership. You have to focus on the vision of what you want the company to look like post closing. The dollars will take care of themselves.
So look, in okay, private equity is not evil. Are they always the best partner? I mean, is that where I'm going to get the most value? How do I kind of think about the right buyer?
Good question. Um, Start with the definition of success.
Hmm.
What do you and your management team want to do next? If you as the owner are deeply involved in making every decision, it's hard to walk away. And so it really comes down to what do you want to do as a transition plan? If you, as we like to say, we use a really bad driving analogy. I got to come up with a better one. But do you want two hands on the steering wheel and be able to go, 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 and 2 feet on the gas? Or do you want one hand in the steering wheel, just sort of cruising, and maybe I get elevated to a chairman or something
Hmm.
that's a perfunctory role that doesn't really matter? Or am I laying back, in cruise control? Or do I want to get out of the car all completely?
Hmm.
So we've got to ask that question first: is what do you want post closing to look like? And then we work backwards. If you want two hands on the wheel, or even one hand on the wheel, and a foot on the gas, private equity can be a great solution.
Hmm.
If you say I want to walk away, and this is better in the hands of somebody else, then that leads you to strategic. At the end of the day, the valuation impact of that is about the same. Believe it or not, the private equity guys hate strategic folks in the auction process. Oh, they drive up the value because they have synergies, right? This the bad news is the strategic hate the private equity guys because they keep driving up prices because they're focused on growth, right? And
Okay.
so both are true. So our recommendation is go talk to them both, and then you can make an informed decision on who brings the right vision, who brings the right value, and the right values, meaning the ethos of the company and the right culture. Then you can make an informed decision and have real confidence at closing that you're doing the right thing.
I often hear from my clients, my business owner clients, that I know who the strategic buyer would be. I mean, I know the industry. I've been doing this for this many decades or whatever, and so what do I need help with really? Because I'm going to talk to the guy who would be the buyer. So, you know, obviously, my point of view is that that's a pretty limited way of thinking about buyers, and there's probably other things to think about. But what are those things I need to think about as a potential seller?
Yeah. Well, let's start with where you started, which is I know the buyer, I know everything, I know how this industry works. I don't need it.
Mhm.
Right. Sure you do. How many times have you sold your business? Right.
Yeah.
I don't know how to make a
Well,
widget.
that's a great point because right, you know the industry, but you're not a professional seller. Yeah.
So when we get there, it's amazing to see at the end of the day, if we do our job right,
Mhm.
if we're allowed to do our job right and have multiple bidders, it's amazing to see the value of competition.
Mhm.
We don't have to go full disclosure to everybody, but having multiple people, it's amazing to see what you think. Statistically speaking, the obvious buyer is not usually the winner,
Mm.
believe it or not. And
Interesting.
so if you look
Okay.
at the offers, there's about a 50%, if we do our job, all right, we run a reasonable process and we get 8, 9, 10 offers for a company. If you take that first offer, because I know the buyer, I have an exclusive conversation and I'm going to do the deal with him. Do you think he's going to put the best price on the table first?
Right.
Probably not, right? Because he doesn't have any competition. But if you now do a process, we see the lowest bid to the highest bid is usually a 50% spread.
Wow. That's much bigger than I expected.
Yeah.
Oh, interesting.
It's about 50% from lowest to best. And so now you drop the half of them out, just say you're not even close on valuation. Let's talk about the guys who see value in us. And then you run a process, and those we can keep ratcheting up in
Mhm.
terms of dollar value. What's more important at the end of the day, though, rarely in those situations do they take the highest price because
Mhm.
there's some other definition of value that makes sense. Closing conditions, terms and structure, taking care of my management team, culture,
Mm.
speed to close. There could be any number of things depending on what's important. But just because you know the buyer does not mean you know how to run a process. And we always recommend running a disciplined process to maximize the outcome. Not necessarily value, but all the definitions of value.
Mhm. Mhm. Interesting. Um, so the other thing I often hear from business owners is, I want to think about this, I want to talk about it, but I'm really scared about kind of making employees know that this is in the offing, and they're really worried about the confidentiality and just what's going to happen if they start a process and that kind of reveals their intentions.
Thank you for bringing it up. So, number one fear of business owners is how do I tell my employees,
Hmm.
right? Because they're all going to run for the hills. They're all going to get fired. They're all
Hmm.
going to be worried. So, we recommend a couple of different things. First and foremost, your closest management team, bring them under the tent early, make them feel part of the process.
Hmm.
They add an incredible amount of value in identifying issues, in telling the story about the company, about the opportunities that exist, far beyond the owner. The owner obviously knows everything, but the detail is down with management team. So we recommend bringing in the top 3, 4, 5 lieutenants um, in under the tent, and we do that with really by giving them an incentive. Is sort of we found to be one of the best ways. Closing bonus payable at closing, half of it at closing, and half of it a year after closing. We want you to be excited about the buyer, so we want to incentivize you to stay. What does that do? That lowers risk of the transaction, increasing value, and then you share the wealth with your management team. But
Do you,
that can be limited to 4, 5, 6 people. That doesn't mean to
do
be a lot.
do you have the conversation about what the size of that bonus is even before a sale, or is that part of
Oh
the
yeah, no,
sales
we do
process?
that at the outset of the engagement.
Hmm.
Um, and there's no rule. Again, it's sort of the owner knows best. Um, General rule of thumb tends to be one-time salary.
Hmm.
We see that more often than not, but we've seen that anywhere from 5, 10, $15,000 up to millions of dollars. It
Hmm.
can be based on a percentage or a multiple of salary, a percentage of the transaction value.
Hmm.
there's no right answer. It depends on what feels right and what would be meaningful for that management team. So there's no right answer there. So first tranche, bring your management team bring them under early, get them engaged in the process. They also know who the buyer might be or who another industry player might fit well, or because they're a little bit closer to the front lines than the owner usually. When it comes to bringing the rest of the team in, we're going to keep this really quiet. We're going to work with your management team. As you start having management meetings with buyers and they want to meet the rest of the management team, maybe you bring in the next level of management, maybe not, depending on how your company is structured and who's making decisions and who can articulate the story. The most successful ones that have really engaged management teams, so we'd like to bring in the next 5 or 6 after that. So now you're talking about 8 to 10 people out of your entire organization. Usually 4 or 5, maybe 8 to 10, but that's it. Mm-hmm. What we love is coordinating the closing announcement. When the buyer or the investor comes in and says, here's where we're doing, this is our vision, that we're so excited for this partnership, with the message of it's business as usual, but better. What we see is benefits tend to get better. Growth opportunities get better. Career advancement tends to be better. Ability to move around the organization gets better. So there's a lot of benefits to partnering with something like that are sort of beyond the normal scope of ownership. And that messaging has to be really good. What are employees worried about? They're worried about 3 things. Do I still have a job? Absolutely. In the middle market, private equity and strategic buyers invest in businesses to grow them. They don't shut down factories. They don't do that. Mega deals, maybe because you're doing cost savings, but in the middle market, they invest in businesses. So do I have a job? Absolutely. Do I report to the same person? Absolutely. You're saying no one's leaving here. It's just an investment. We might add more managers. We might add more employees. We might add more technology or infrastructure, but the people are what's really important. And so they stay. So you still have a job and you're reporting to the same person and doing the same thing. If you want to, now the opportunity to have career advancement might be better, but as of closing for the foreseeable future, business as usual, but better.
That makes a lot of sense. Well, look, Ramsey, I feel like we could talk forever here. There's a lot to discuss, and this is a really important topic for our business owner clients. But I felt like we really got into the below the surface and into some of the meat here, and helping owners get past some of those fears that you were mentioning. That's a huge deal, and I really appreciate you joining us today, and look forward to keeping connected, and we appreciate everything you do for our clients.
Michael, thank you so much for having me. Really appreciate it today, and this is a lot of fun. Let's do it again.
Yeah. All right. Great. Thank you very much.
Thank you, sir.
Thanks for listening to this episode of Business Owner Bootcamp, presented by Wellspire Advisors. If you have any feedback or questions, including suggestions for future topics and guests, reach out to your hosts or send us an email at clientrelations@wellspire.com.